Welcome back to Incompetent Capital, where today we expose the baffling blunders of 5 analysts who've seemingly thrown their expertise out the window when it comes to Akamai Technologies, AKAM. What could have been a straightforward analysis has instead turned into a circus of incompetence, leaving investors scratching their heads and wondering how such miscalculations could be made by those who claim to understand the market. As we sift through the wreckage of their misguided forecasts and reckless recommendations, we'll take you inside our Incompetence Court, where these analysts will face judgment for their failures. How did they miss the crucial shifts in Akamai's performance metrics? Did they ignore the very data that could have saved investors from significant losses? Spoiler alert, the answers are as shocking as they are infuriating. But hold on, this isn't just a roast of clueless analysts. We'll also dive deep into Akamai's fundamentals, uncovering the layers of its business strategy that these analysts overlooked. What lessons can we learn from their mistakes? As we unravel the mystery behind Akamai's stock performance, prepare to discover the crucial investment principles that every savvy investor should keep in mind. In a world where so-called experts can lead you astray, it's time to sharpen your understanding and protect your portfolio. Tune in as we expose the incompetence, reveal the truth, and equip you with the insights needed to navigate the turbulent waters of investing. Before we dive deeper into today's shocking revelations, I want to quickly highlight something that can complement your investment journey. If you're looking to diversify your sources of income in a way that enhances your financial strategy, check out Matt Parr's Tube Magic course. Navigating YouTube automation can feel overwhelming, especially with so much misinformation out there. That's where Tube Magic comes in. This class teaches cutting-edge AI tools that will help you create a successful YouTube channel in no time. It offers proven strategies to help you automate your YouTube channel and maximize your earnings. With step-by-step video tutorials and a supportive community, you'll gain the tools you need to streamline your content creation and thrive on the platform. Today, we will delve into one of history's biggest bloopers on analysts' behalf, the calls made on the stock for Akamai. Most analysts have gotten this wrong, and if anyone actually followed their stock estimates, they would buy high and sell low, and probably dish their life savings out to make horrible calls that land them in a homeless shelter. Absolutely egregious. For example, James Fish of Piper Sandler pulled that classic chase and cheer and followed that up with the infamous move of calling neutral on the crash. He is being charged today with neutralism fraud, or defrauding investors with neutral calls to protect his investment bank's client. James began covering this stock in 2018 with a series of buy calls with price targets that were reactive to the stock as it rose on its bull run. This game of chase and cheer is something we see very often from analysts. James followed his chase and cheer run with a series of neutral calls as the stock began to tank. This is a move that demonstrates something more sinister that we have been exposing on this channel. Analysts often fail to make sell calls on companies that they report on because they don't want to tarnish the relationship of their firms with the companies they are reporting on. These firms do big business with these companies the analysts are supposed to scrutinize, and this creates a conflict of interest. So for our sake, we need to understand that a lot of times when an analyst calls neutral on a stock, especially in the midst of a crash, they are really saying, "Sell, baby, sell," guilty on all charges, and sentenced to a life of making sell calls on all of his favorite companies. Our next culprit for the day, Rishi Jaluria, is being charged with gross incompetence. Rishi began covering the stock in 2019 and also grabbed his pom-poms, stood next to James, and began cheering with the cheer squad. He made a series of buy calls and chased the stock price up, only to amp up the price targets to grossly overbid as the stock approached its peak. And this guy didn't even call neutral as it crashed. He simply lowered the price target's aggressiveness to revert more towards the price of the stock and kept cheering buy, only to turn around in the trenches and call sector perform, which he holds to this day. He would have had a win with his 97 bid in November 2023 if he had called sell and not chased the stock up. But unfortunately for him, he is addicted to chasing, and A, couldn't hold his underbid, which actually came true a few months later, and B, he never called sell. And of course C, he was way too late and grossly incompetent all around on this one, guilty as charged, and sentenced to a life of manual number crunching at your nearest investment bank. Our next defendant today, Fatima Boolani of Citi, is also being charged with gross incompetence. Fatima began covering this stock around the peak in 2022 and jumped in headfirst to the cheering party with a buy call. Problem is, that she was cheering on the way down. We can't be too harsh on the first buy call because she was new on the stock, but it was incompetent to continue cheering into the crash. She then decided to turn around and call neutral in the trench. She holds this sentiment to this day. And also, interesting to note, the significant overbid of 135 and 140 when the stock was trading at 124 and 109, respectively, in January and April of 2024. How can you possibly call neutral with such ridiculously overpriced targets? Obviously, she had an opinion on those calls, or her finger slipped and she typed the wrong thing on the keyboard before submitting her price target. Either way, guilty as charged of gross incompetence. Michael Elias of TD Cowan was another late joiner to the Akamai Cheerfest, but he wins Akamai Technologies Cheerleader of the Year award because he never once even called neutral. Michael began his coverage right after the peak in 2022 and began cheering away with such passion that he forgot to call neutral in the trench of the crash. AKAM management loves this guy. He reverted his price targets to match that of the stock in a game of chase after the crash, but then overshot again, all done with buy calls which he has held to this day. Even if he turns out to be right and this stock makes a huge run, he still lost way too much money for way too many people. Do your homework and time this stuff out better, guys. Your entire life is just this, and you can't even get it slightly right. Guilty of gross incompetence. Rudy Kessinger of Davidson is being charged with 1 count of gross incompetence and 1 count of copying Michael's homework. Look at that chart. Looks like these two must have collaborated on this one. Rudy began coverage right before the crash in December of 2021 and followed the same playbook as Michael. Buy, 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 they shouted with Jim Cramer of Mad Money. We love you, Cramer. We don't need much analysis. The chart speaks for itself on this one. Rudy also won Akamai's Cheerleader of the Year award and is guilty of gross incompetence and not guilty of copying, because the chart actually shows that Michael was likely the one doing the copying here. As we can see, he joined the party later. Disclaimer: Incompetent Capital is for entertainment purposes only. While we critique the missteps and mishaps of financial analysts, we acknowledge that they likely tried their hardest and simply made a bad judgment or two, or maybe 300. Our aim is to highlight the funnier side of investing and analysis, not to make personal attacks. Please note that we may sometimes add fictional elements to the storyline for entertainment purposes. And finally, remember that even the best professionals can miss the mark. So laugh away, but please avoid making personal judgments about the analysts we report on. As we wrap up our roast of these analysts in our Incompetence Court, it's crucial to shift gears and dig deeper into the context surrounding their blunders. Understanding the intricate background of Akamai Technologies is essential for grasping how these misguided forecasts emerged. Akamai Technologies has long been a leader in content delivery and cloud services, providing essential infrastructure for internet performance and security. However, despite its strong foundation, the company faced significant challenges that contributed to a dramatic decline in its stock price. The downturn can be attributed to a combination of market pressures, operational missteps, and changing industry dynamics. For starters, a surge in competition from emerging cloud service providers intensified, forcing Akamai to lower prices to retain clients, which eroded its profit margins. Additionally, the company's heavy reliance on a limited number of clients for a substantial portion of its revenue raised concerns about its long-term stability. Misjudgments in forecasting demand led to inventory mismanagement and overcapacity, further straining its financials. This operational inefficiency was exacerbated by an inability to pivot quickly enough in response to evolving customer needs and technological advancements. As investors began to see these red flags, sentiment soured and the stock plummeted, leaving analysts scrambling to reassess their positions. Ultimately, the combination of strategic miscalculations and external pressures created a perfect storm, resulting in a loss of investor confidence that sent Akamai's stock spiraling downward. Today's take-home lesson from this story centers on two crucial insights that every investor should keep in mind, especially in the tech sector. First, we cannot stress enough the recurring theme we've seen throughout our analyses: the failure to adapt. In an industry as dynamic as technology, companies that cling to outdated strategies or underestimate the speed of market changes often find themselves left behind. Akamai's struggle illustrates that agility and innovation are not just advantageous, they are essential for survival in a fiercely competitive landscape. To assess whether a company is facing this issue, investors should look for signs such as stagnant product lines, a lack of investment in research and development, or delayed responses to emerging trends. Additionally, monitoring management's willingness to pivot and embrace new technologies can provide insights into their adaptability. Secondly, it's vital to diversify revenue streams and avoid over-reliance on a limited number of clients. Companies that depend heavily on a few key customers can quickly find themselves in jeopardy if those relationships falter. A broad market presence not only mitigates risk, but also enhances stability, allowing firms to weather economic fluctuations and changes in client preferences. As we continue to navigate the turbulent waters of investing, keeping these lessons in mind will empower us to make more informed decisions and safeguard our portfolios against similar pitfalls. To gauge a company's adaptability and financial health, investors should look for specific indicators in its financials. Key metrics include revenue concentration ratios, which reveal the percentage of total revenue coming from the top customers. A high concentration ratio may signal potential risk, as losing one major client could significantly impact overall revenue. Additionally, analyzing year-over-year revenue growth can provide insights into whether the company is expanding its customer base or relying on a few key accounts. Investors should also examine the company's revenue diversification across product lines or services. A balanced portfolio with multiple revenue streams indicates resilience and the ability to pivot in response to market changes. Furthermore, monitoring cash flow statements for consistent positive cash flow can signal operational stability, while fluctuating cash flows may indicate over-reliance on specific clients or projects. By focusing on these financial indicators, investors can assess whether a company is well-positioned to adapt to market dynamics and maintain a stable revenue base. Keeping these lessons in mind will empower us to make more informed decisions and safeguard our portfolios against similar pitfalls. Feel free to check out this video for a deep dive on fundamental analysis.